There's been a lot going on in the financial markets, and that's an understatement. The government's been shut down, the price of oil has been plummeting, Jerome Powell has some words to say about the economy, the trade war made a comeback, earnings season is officially back, so let's talk about it. First off, with the government being shut down, a few important economic data doesn't get reported, and that includes inflation data as well as job data. And how are we supposed to know that the labor market is suffering without the data? And there's estimates that the government will continue to be closed for at least another 2 to 3 weeks. And why is that important? Well, the Federal Reserve will be making the decision to either cut interest rates on October 29th or leave them unchanged. And they make the decisions based on the current economic data. And if we're not getting anything from the government, then are they still going to be cutting interest rates like they projected? Well, the Federal Reserve Chairman Jerome Powell spoke about the whole situation just the other day. So take a listen.
Although some important government data have been delayed due to the shutdown, we routinely review a wide variety of public and private sector data that have remained available. We also maintain a nationwide network of contacts through the reserve banks who provide valuable insights which will be summarized in tomorrow's Beige Book. Based on the data we do have, it's fair to say that the outlook for employment and inflation does not appear to have changed much since our September meeting 4 weeks ago. Data available prior to the shutdown, however, show that growth in economic activity may be on a somewhat firmer trajectory than expected. While the unemployment rate remained low through August, payroll gains have slowed sharply, likely in part due to a decline in labor force growth due to lower immigration and lower labor force participation. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. While official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue their downward trajectories.
So he said that there's still available data that's being released to the public, and judging from that data alone, the labor market is still worsening. So the Federal Reserve stance remains the same. They're still expecting to cut interest rates in October, followed by a whole path of rate cuts in the upcoming months. Let's take a look at the CME Fed tool, which will give us the probabilities of what the Fed will most likely do at the next Fed meeting. At the meeting on October 29th, there's a 96.8% chance of the Fed cutting interest rates by 0.25% and a 3.2% chance of a 0.5% cut. So they're 100% going to be cutting interest rates again. They're just debating on how big of a rate cut that they'll do this time around. And what does this all mean for the stock market? Well, as you may know, when they start cutting interest rates, the price of assets typically go up. Now, this isn't financial advice, but I've been buying stocks whenever I see the price dropping. And this whole thing with the trade war is providing a good opportunity to do just that. Speaking of which, in case you've been living under a rock, the US and China trade war has made a comeback. One day, the president says that they're going to be placing a 100% tariff on China.
It's not racist at all, no, not at all. It comes from China.
And the next few days, he says that everything's going to be fine, followed by Scott Bessent saying that the 100% tariff doesn't need to happen. And of course, a day or two later, the president says that we are considering terminating business with China having to do with cooking oil. He also says that we can easily produce cooking oil ourselves. And I thought that was funny, but apparently even that made the stock market sell off a bit. But hey, I'll take it. Another reason why the market's been selling off a bit is because people are taking profits and placing them in low-risk assets like treasuries or even gold, which is another story in itself. But if you take a look at the VIX, it's been climbing up a bit over the last week or so. And if you don't know what the VIX is, it's pretty much an investing tool that can be used to see if a lot of people are confident in the stock market or not. So if the VIX is high, that means that a lot of people, as well as institutions, are placing hedges against the stock market. That's the simple definition, but I like to look at the Fear and Greed Index because it can give us the whole picture of what's really going on. Right now, we're at extreme fear, and typically this is when I start adding more money into the stock market. It's pretty interesting to see it at extreme fear when the market is pretty much at all-time highs, only 2% away from it. But let's take a look at this a little bit closer because this uses 7 indicators to come up with these calculations. The first is market momentum. It just tracks the S&P 500 along with the 125-day moving average. Then we have stock price strength. Then the stock market breadth. Then after that, we have put and call options ratio, which you can imagine People are buying put options a lot more than call options. Then we have the market volatility, which is the VIX along with the 50-day moving average. And lastly, we have the safe haven and jump bond demands. So with that said, we're at extreme fear levels, and you already know the saying, when the market's fearful, be greedy. When the market's greedy, be fearful. So I'm going to be continuing to buy stocks as they continue to drop, especially since we know that they'll be cutting interest rates once again. A lot of people are talking about fears of stagflation, which is pretty much the inflation going up a lot, as well as the increase of unemployment and slow job growth. And although the labor market is suffering, inflation is barely going up. And in my opinion, it's certainly nothing to be worried about just yet, because take a look at the price of oil. Crude oil has dropped to its lowest level since May of this year, and it's mainly because OPEC agreed on further oil output boost this month. And with oil dropping, it should trigger a domino effect on gas, and that should help decrease the prices of goods across the country, which will reflect on next month's inflation data, assuming that the government's back open. They also expect record oil oversupply next year, which should also reduce gas prices as well. So if everything continues to go down this path, then maybe the Fed would be able to cut interest rates a little bit more aggressively. But that's just me being optimistic. And the last thing I'd like to talk about is earnings season being officially back. And it started off with banks reporting earlier this week, and it was actually a bit concerning, because major banks like Western Alliance and Zions Bank dropped over 10% after reporting, which dragged down other regional banks as well as the entire stock market along with it. This happened because Zions and Western Alliance Bank gave out a lot of risky loans back when interest rates were low, specifically for commercial real estate and small businesses. And now that interest rates are higher and the demand is weakening, many of these borrowers are having a hard time keeping up. So all of these banks reported huge losses as well as fraud in a few cases. And the CEO of JP Morgan, Jamie Dimon, also said that his bank took a $170 million hit from Tricolor bankruptcy. And he said that if you see one cockroach, there's probably more, stating that he wouldn't be surprised if other banks are going through the similar situation. And this made some investors worried, hence the increase in the VIX. But with all these things going on, I'm not freaking out and selling my entire portfolio like a lot of people are doing at the moment. If anything, I'm buying more in dollar cost averaging as all this is taking place, and I'll continue to do that as time goes on.